Hi, it's Riz from R3 Mortgages, and welcome to today's webinar about the future of buy-to-let. In today's webinar, we're going to be covering a number of topics, but the purpose of putting the webinar on is a direct response to the events of this week. Number one being the increase in the UK Bank of England base rate, and number two, to the mini budget and to discuss what the proposals will mean for buy-to-let landlords going further. And ultimately, what we're going to be doing is we're going to be answering the question, is there still a future in buy-to-let in 2022 and beyond? My name's Riz Malik, Director of R3 Mortgages, and it has been a very interesting week, and I would like to take the opportunity to share with you my observations and also our thoughts going forward. So without further ado, let's begin. Okay, before we commence, just a short disclaimer here. The presentation here is for information purposes only. It doesn't constitute advice and it's aimed at professional landlords. You should always seek professional advice in relation to your own personal circumstances. Okay, so what an interesting week it has been in the world of the interest rates. Now, with the Queen passing away, the original decision from the Bank of England was postponed by a week. And there was a lot of sentiment in the market that there would be a rate rise, specifically because the US Federal Reserve had increased their rate by 0.75% the previous day. We did receive a rate rise and it was by 0.5%. This is in addition to the previous rate rise as well, increasing the Bank of England base rate in the United Kingdom by 2.25%. This is the highest level since November 2008 and the advent of the credit crisis around the world. Now, although the rates have increased in a historical content, they are still lower than what they have been previously. Prior to the credit crunch in the UK, we were looking at a base rate of 5.75%. However, we have been spoilt in this country with low interest rates. And for years and years and years and years and years, I've been saying to people, the rates are the lowest that I've ever known them. Please enjoy them because they won't be around forever. And within a short period of time, we have started to see the increases off the back of the problems that we are facing around the world. Primarily at the moment, the global inflation crisis, which is driven predominantly by the instability of the world and the global conflict, primarily in Ukraine, having an implication on gas supplies. Now, with interest rates, economically speaking, if you have an economy with rising inflation, interest rates are a perfect metric to use to try and bring inflation under control. Inflation currently is not just a UK problem. Inflation is a global problem. Every country around the world is facing this issue at the moment. However, the UK specifically does have one of the highest levels of inflation in the Western developed world, let's say. And currently it's sitting at 9.9 with projections that it will go into double digits. Now, the target for UK inflation is 2%. So we're nearly 5 times over where it needs to be. Since 1997, and when Labour came into power, the decision with regards to interest rates has been separated and the task was handed over to our central bank, Bank of England. So since 1997, there is a division between who sets the interest rates. And in the UK, since 1997, it is the Bank of England, independent of the government. However, The government and the Chancellor of the Exchequer specifically does set the target to the Governor of Bank of England. And if the Governor of Bank of England misses that target, he subsequently got to write a letter to the Chancellor explaining what the situation is. Obviously, there have been letters going back and forth, but it hasn't got the problem under control. The Bank of England has been alleged of being too late to the party, i.e. starting to raise interest rates late in the day when they should have raised them a lot earlier. And potentially, if they had done so, we may not have been in this situation. But hindsight is a lovely thing. We don't know if that would have helped. We are where we are, and this is it. So currently in the UK, we have a base rate of 2.25%. Inflation's not going away, in my opinion, until the issue of Ukraine is sorted out. And considering, again, the events of this week and the further escalations in the area and Russian conscription now towards increasing their effort in the region, I do not think that is going to be resolved anytime soon. And the stranglehold that it has on the global's gas reserves, which is a big driver of where we are at the moment, is going to still be here going forward. Now, the rise in interest rates throughout the whole of this year has led to a rush to lock in mortgage interest rates for people coming up to renewal. Now, whoever your borrowing is with, dependent upon how they operate, they may offer you certain rates if your mortgage deal is coming to an end. Now, on average, they usually offer those dates 90 days before your deal expires. The problem therein being is where you've got a period of volatility and rising interest rates, people generally want to try and secure the deal as soon as possible. Historically, if your mortgage deal was ending, you could probably get away with 6 weeks before it was ending, look into the market or engage the services of a broker to look into the market, see what the options were, put in an application, bish, bash, bosh, it's done and it's changing. Now, what we have found, especially over the last 4 to 5 months, is lenders are becoming awash with business. They are receiving well over their daily capacity allowances in certain cases, meaning that they want to hold down and calm down the number of applications that they receive in order to preserve their service standards. So what that means is that they can usually either withdraw from the market or they can increase their rates so they're no longer appearing attractive on the many different systems that we use to source mortgages. The key problem that you've got is, on top of increased service standards by lenders and the long time that that's taking, with rising interest rates, it could mean that lenders are and have been repricing very regularly. Now, usually a mortgage lender may reprice once or twice within a certain period of time. I might give somebody a mortgage rate and 6 weeks later, maybe a few weeks later, whatever, that rate is still there. You're now in a situation where, as brokers, we may, for nothing intrinsically that's happened in the market, we will get a notification from a lender saying that they're now going to be repricing and they're pulling their rates and they're going into the open market and they're going to be securing new rates. So your deal has to be in by, let's say, 5 o'clock to secure the client the rate. Well, if you've just shared the illustration with them or you haven't done the rest of the processing and you've got a number of deals on your table, that's an unrealistic timescale. And lenders have been doing that on an increasing basis. Now, the argument from the lenders is that there is a lot of instability and there is a lot of volatility of how they are raising their funds, predominantly in the swaps rate in the open market. And we're going to come to that in a moment. Now, with interest rates, there are further increasing rates further increases ahead that are possible. Okay, if we look at what's happened in America, they've increased their base rate by 0.75% concurrently on a number of occasions, and they're facing much higher mortgage figures and rates that we are at the moment. So considering where we are versus our inflationary target, there is a long way to go. So I personally do not think this is the end of the interest rate increase in the UK. I believe that there's further meetings of the Bank of England in 2022, and there will be in 2023 as well, which would normally trigger the time when there will be an increase or a decrease in the rates. But I think watch this space. It's only going to get choppier going forward. Okay, so the next thing moving on is the mini budget. Our new Chancellor of the Exchequer, Kwasi Kwarteng, announced and was on his feet for his first budget or mini budget from Liz Truss's arrival a few weeks earlier. It was a very interesting mini budget. I'm not sure what a lot of people were expecting, but off the back of increasing energy costs and increase in cost of living, I think with every budget, there's always going to be disappointment thereafter with people thinking that they've been shortchanged. There were a few positives that have come out of the budget, especially for landlords and those who are involved in property. The cap in energy costs is advantageous because if you are renting out the property and you are a HMO landlord and you're taking the utilities as part of the service that you're offering, and or you do have tenants, there's now going to be a cap in terms of their energy costs. So that helps in that particular scenario. The stamp duty changes, again, I'm not really sure what the purpose of those were, but they have been introduced. The biggest change is the increase in the amount before you pay stamp duty, rising from 125 going up to 250. However, for landlords and for property professionals, there is still the increase that you will pay on top. So it is beneficial, but it doesn't mean that you're going to be able to buy property without paying stamp duty. The other advantage was for first-time buyers. Now, this is advantageous for first-time buyers, but for landlords, if you are competing on a property versus somebody else, and they've got lower closing costs, essentially because they're not going to be paying as much stamp duty, they may be prepared to bid more for the property. So if you're looking at first-time buyers and landlords competing for the same stock, it just became a little bit easier for them. But ultimately, what it does mean is that there's an increase in the amount of disposable income. Now, that's advantageous for a number of obvious ways. And I've put it here, according to the Times calculator, the benefits that certain people will find. So if you're earning £25,000 a year, you're going to be £279.68 better off. 50,842, 75,000, 1,157. But the people who are benefiting the most are those who are earning over £150,000 because, and I think to a lot of their surprise, their rate went down from 45% down to 40%. So that, coupled with the scrapping of the increase in national insurance, coupled with the fact that bonuses for bankers have been had their cap removed now, means that there are a lot of people who are celebrating. So generally, in your pocket, you will be better off. But a lot of that increase is going to be swallowed up by the hike in the rate that you're paying for your mortgage when it comes up for renewal. So although you might be saving money, if your energy costs have gone up and your mortgage costs have gone up, then that is going to make things difficult. Now, I foresee that mortgage lenders, especially with buy-to-let landlords, are going to try and evolve to making sure that deals can still happen. And one thing that I think that they're going to do an increasing amount of is something called top slicing. Top slicing occurs when you have a situation where a lender has got a rental calculation where they base how much they will lend on the value of the rental income that is being received, and also the taxation situation of the applicant or applicants. Now, if that calculation comes to a figure that is not sufficient for the loan that you are looking at, top slicing means the lender will look at your own personal income, see if there is surplus income there, and essentially apply some of that flexibility to their calculation. So from the lender's point of view, okay, if the tenant can't pay the rent, how comfortable are we to lend this person a little bit more, considering that they've got disposable income themselves to make up any shortfall? So I think that will be the saving grace going forward. So again, the disposable income increasing is going to be advantageous from that point. So what are the implications, the main mortgage implications, which a lot of people are going to be concerned with? Now, as I mentioned, because of the change in the calculations, especially for buy-to-let landlords, I predict that there is going to be a reduction in the loan amount that will be available, especially for high rate taxpayers and especially in London and the South East. Now, the situation that we have is historically a lot of landlords, and I'm going back a number of years, used to buy a property, take out a mortgage for 2 years. After 2 years, property's gone up in value. They'd refinance, pull out some of the equity for deal 2 or to do something else with, and then go again. And where we've had a historic rising market, you can repeat and replicate that, thus pulling out money each and every time and increasing the total debt that you have on the portfolio, but utilizing the equity to grow the portfolio. However, what's happened is over the last few years, with changes in legislation, excluding for limited company borrowing, to put that to one side, a lot of lenders have been giving favorable calculations to people who take 5-year fixed rates as opposed to 2 years. So straight away, we've seen that situation where rather than doing this exercise every 2 years, customers are being tied into 5-year deals, which makes it harder for them to take money out as frequently from the portfolio. But the benefit to them has been that they've been able to borrow more money using the 5-year calculation. However, and this is where the problem comes in, the 5-year calculation is based on the lender's rate, usually pay rate, which is the interest rate on their 5-year money. And they'll normally apply a discretionary calculation to the way that they calculate the rental income. So they may say that they want to cover the mortgage payment by 125 or 140%, dependent upon the lender, dependent upon the tax position of the client, assuming the rate on the mortgage is the amount of the 5-year fixed. I hope you're following me. Ultimately, what this means is that if your 5-year fixed rate has gone up, let's say from 3.5% now to 4.5%, and you're using the same calculation, the rental income may have not changed drastically in that period. The ultimate figure that you are going to get out of the bottom of that calculation is going to be lower. So what you will potentially find is people become, inverted commas, quoting, mortgage prisoners, which means that they are stuck with their current lender. Now, the lender might have put them in a 5 or 2 year deal, but the term of the mortgage is over, let's say, 20 or 30 years. So the lender will still offer them a follow-on rate or a new deal, but they haven't got the option as such of going out into the market because other lenders won't offer them enough to clear the current debt, without them having to put their hand in their pocket and maybe contributing towards increasing the amount of deposit that they put down, especially when refinancing. So what you'll see is more people, rather than when the mortgage comes for renewal, remortgaging to another lender, will be staying with the existing lender and negotiating a rate. Now, the other thing that problem that has is, obviously, if the lender knows that you don't have a lot of competition for where your business can go, because of the maths, they can ultimately charge you. They don't have to be as competitive as if they're competing with bank B, C, or D. So in some cases, that may be your option. Now, the advantage of that is if you do that and stay with the lender when your mortgage deal comes to an end, that's classed as a rate switch. A lot of lenders will use automated valuations for your properties, and they will also not require income such as income verification or to go through the whole underwriting process, because ultimately the debt is already with them. So there are advantages for that point, but there's less competition, and I don't believe that's ever a good thing. And again, you're going to have a more limited choice of lenders. I think a lot of lenders, the number of mortgage deals and products, especially over the last 6 months, we've seen a decrease in that. When lenders can't cope with the processing, what we've found now is that they are withdrawing from the market. So lenders coming back and saying, we're leaving the market for a short period of time to catch up and we'll come back in. What means is that there's less competition again within the market, which is never a good thing, and a lower number of choices. And the people who are there can ultimately raise their prices if they want to, because who are they going to compete with at the end of the day? So this is something I'm very concerned about, and I'm seeing an increased amount of, but unless there is action, I'm not sure how we're going to get around this situation. Another point that I'm very worried about, particularly on the specialist lending side, and here I'm referring more to, let's say, limited company lending, or lenders that don't, let's say, have a traditional banking arm, is the situation where a lender will pull or reprice applications. If the economy does take a downturn, it is not uncommon for lenders to pull applications. What that means is just because you've got an application with the lender doesn't mean you are safe and secured. They could pull it, or if the case hasn't gone to offer, they could cite that they're repricing or doing whatever, and you don't have to continue your application. Or alternatively, if interest rates are increasing in a fast-paced way, and they've given you a rate, let's say a number of months ago, and rates have moved north prior to the deal concluding, they could turn around and say that you have to select a new product, or the deal's been going on very long, or you've got until X date to get the offer out before, or you have to choose another product. I had a similar situation on the case, even going until Friday, where the lender had given us a deadline that if the case doesn't offer, then we are going to have to ask you to choose from the new rates that are available on the market. Now, the issue that you have got is it's not just about having to pay a slightly higher interest rate on those transactions. The calculation which the loan is based could then be repriced, meaning that the loan amount will be lower. So if you have got a mortgage application in, it is imperative, in my opinion, at a point of instability or when we've got economic uncertainty, to get from application to offer as soon as possible. Now, as we saw in the credit crisis, offering doesn't mean that everything is done and dusted, but it is in a better position than if you've just got an application in. So that's the one thing. Get your application in, get all the docs in, move quickly. So if the economy does take a turn and lenders get fearful, you are not caught out about that. I also believe that we're going to be entering into a period of stricter lending. Lenders will be scrutinizing applications even more than they have done historically. Lenders will also be looking potentially at the business areas that you are in if you are self-employed, and apply an approach to how likely is that business going to be affected historically. When you are doing a mortgage application, whether it's residential, buy-to-let or whatever, we're always looking for self-employed applicants about what has necessarily happened in the past, because the lender asks for their tax computations for the last 2 years. However, again, in times of instability, and we saw this during COVID as well, what the lenders can do is then apply their own approach, a risk-based approach, to see how likely it is that they believe that that income is likely to continue going forward. For example, during COVID, it was hard to argue during lockdown that a hairdresser could operate and trade when they couldn't, just irrespective of their historic earnings. And I think a lot more lenders are going to be scrutinizing applications more in order to make sure that they balance the risks for themselves. Another point here is that historically, there have been a lot of customers and clients on mortgages who have benefited from tracker rates and variable rates and discounted rates. And that's been great when we have been in a low interest environment. However, with rates increasing so sharply in the last 6 months, and also with the likelihood of there being further increases, I would urge people who have got tracker rates or have got discount rates to review their situation and to still ensure that it meets their needs. I am not saying if you've got tracker rates, sack them off and lock in the money straight away. I am saying if you are on a tracker and you do have concerns about rising interest rates and rising costs of you servicing that debt, it may be a good time to review your current situation. I therefore, to conclude this section, do believe that there's going to be massive implications with regards to the mortgage market as a result of interest rate increases. So the juicy bit, how can you ensure that you maximize returns on your buy-to-let portfolio? Now, the one thing that you can do straight away is, if your cost of borrowings are increasing, is to increase the rents. Now, a lot of landlords who I deal with have got long-term tenants and they start off on a certain rent and very seldom increase or review them. If you are running property as a business, it is a business, and therefore the numbers need to stack up. Otherwise, you are going to find that you very quickly are going to be subsidizing your business, and it's going to cost you to have these properties more than it does at the moment. So if you do have properties where you haven't reviewed the rent in a number of years, I would suggest that's something that you consider. The second thing that you can do to improve the efficiency, the second thing that you can do to improve and maximize the returns on your portfolio is to improve the energy efficiency of the properties in your portfolio. Now, leaving aside the mandatory changes that are coming in 2025 for landlords to ensure their properties have got a certain EPC rating, a lot of lenders now have green ranges of products. And on those green ranges, if a property has got an EPC of a certain rating, usually A to C, they will offer more competitive pricing than other properties. A lot of these lenders have got a green mandate and they're being pushed by the government. So that could be a way to do it. You could get better mortgage deals if you do have properties within EPC A to C. A to B for some lenders, but A to C in general. So that would be definitely something to potentially consider. You can get and see what the EPC ratings are of your current properties by looking at the EPC register, which I'll happily share a link with you after in the presentation. It's also time to review your portfolio. If you do have a portfolio, it is time to review it and also to make sure that those properties are still making sense. If you have historic property that you have turned into a buy-to-let because you previously lived in that property and you decided to keep it and rent it out, etc., etc., does that property make financial sense from a business point of view? If it doesn't, this is a great time to review what you're doing, because the changes in stamp duty mean that potentially it might be time to get rid of a few properties in your portfolio and then utilize those funds to buy something that does make more sense, thus rebalancing your portfolio. So I see a lot of people who, and I've heard people say, I buy, I don't sell. But again, if you're getting a better return, or if it's in a better geographical area, or you think that you've made the money on the property and the future increase is going to be less than other areas, this is a great time to review your portfolio. Another stage that you can look at is the buy, improve, and refinance. Okay, if you buy a property and just hold it for the long term, you're just riding the market. You have no control in that market. The main control that you have is by adding value to that property. Now, adding value onto a property on day one by buying something that is run down, needs TLC, needs work, needs a renovation, is one way that historically has been a proven method to maximize your returns. And what you could do is you could purchase the property. It could be an auction property. It could be a property with no EPC. It could be a property that you're planning on extending and you think it's going to add value. Purchase the property. And if it's not habitable by conventional mortgage standards on day one, you could do so via a bridging finance or using your own money. Do the renovations to that property, and then refinance that property based on the increase in the value that you have just added. So, for example, buying a 2-bedroom property and converting it to a 3-bedroom property could get you a greater property value and a greater rental income for a small outlay, maybe of doing a reconfiguration or repartitioning the walls or something like that. That is a historic way that has been proven to add value to your property rather than just buying the property and riding the market. Yes, properties today are more expensive than they were 5 years ago, than they were 5 years before that, and you can go back forever for that calculation. However, by doing that, that's the quickest and easiest way. Buy, renovate, and then even sell, bank the profit, put it in the money to go again, put it in your pocket to go again, or refinance the property thereafter. And there used to be the situation, a lot of people think, oh, I've got to own the property for a certain period before I have to refinance it. There are lenders that will refinance it on day one or from day one. After 6 months, you have got a growing number of lenders who will potentially look at it. But if you are going to be refinancing and renovating a property, please ensure that you keep accurate logs and descriptions of the work that you have done to that property. If somebody has bought a property, let's say at 400,000, and you think by doing the work it's worth 500,000, and I send a value around, or the bank sends a value around, they're not going to know what will need to be done or what hasn't been done or whatever. But if you can show them, here's a portfolio of what it was looking at before. Here's a portfolio of pictures. Here's all the increases that I've done. Here's the, super duper German kitchen I've put in. Here's this, that, and the other. And we've changed all the windows and whatever. They can see the value add that they've done. So my top tip, and people do not do this, if you are going to buy, improve, or refinance a property, make sure that you keep all of the information and the costs of actually doing that property. Also, something else, I'm chucking so many tips your way. I hope you're catching them today. If you are going to have a surveyor visit your property, make their life easier. Give them comparables. If you know property X, Y, and Z has gone for sale or been sold down the street, tell them. If you want to highlight to them what improvements you've been made, tell them when they're viewing the property, show them, give them a sheet of paper to help them with their thing. Don't not do anything and not talk to them and hope and pray that you get the outcome from when the valuer goes round. That's the one source of people who do this, that they do come a crop sometimes, is because they don't get the valuation that they were looking at, but they've done all the work on the bricks and mortar of the property, but they've done no work to convince the person who's going to say how much it's worth. Okay, we're slightly over time, but we're going to be cracking on. And I've only got one more slide after this. Increasing the return per square foot. I had a lunch last week. Was it last week or the week before? myself and Kathy had lunch with a lettings agent, and she was telling me about the work that they've done in terms of getting properties and repurposing them to HMOs, and ultimately turning a 3-bedroom house into a 6-bedroom HMO, turning the rental potential for that property from £1,200-1,300 into circa £3,000. Yes, correct, you've heard it, £3,000 in this scenario per month. Now, going from one type of transaction, i.e. letting on a standard AST, to going to something like a HMO is a big step forward. Now, you can either do that by taking advantage of somebody who's experienced in that field, because the cost of financing is going to be greater, the cost of complying with all the regulations is going to be greater, but long term, that could lead to greater potential gains in your portfolio. So if you do have a portfolio and you have only ever considered AST properties where you're just going to let them out on one AST, I would encourage you to look at the wider picture now, especially considering that your profits on that type of transaction may not be as lucrative with the interest rate hikes, especially in the south of the United Kingdom. Repurposing existing properties. In this particular scenario, it could mean by buying a property that is, let's say, a semi-commercial property, a shop downstairs with a flat above on one title, going in, separating the titles, putting upstairs a flat on one title deed and downstairs shop on a separate title deed, refinancing them at different amounts, increasing the value of the overall property, increasing the value of the flat upstairs because it is on a separate title deed, etc., etc. You need to start being more creative in terms of how you look at a property and how it can be repurposed. It could be a large house, could be repurposed. You may not want to go down the HMO route. It could be split into 2 or 3 flats. That's called a multi-unit freehold if it's all on one title deed, and you can get financing on those similar to HMOs. So that one house might be worth 600,000, but individually those flats could be worth 250 each, which could mean 750,000 minus the cost of doing it. That could be a way to create day one paper profit. Also, if you do that and you do then put the properties on separate title deeds, you could increase the value further on from that and also decrease the cost of your financing, because multi-unit freehold and HMO financing is greater in most cases than standard conventional buy-to-let financing. So you need to be along the way looking and seeing how you can increase the value from there. Now, last slide, threats and opportunities going forward. What are the threats to landlords and their portfolios going forward? We have got a cost of living crisis and tenants are feeling the same situation. So we could have the threat to your portfolio of, due to the cost of living crisis, you could find that you have greater voids from your tenants. I pray to God that that does not happen to you, but it is possible. So make sure that you have the reserves available to fill in those voids. What you do not want in any circumstance is not to be paying your monthly mortgage, because that is going to have massive implications on any refinancing that you do in the future. So make sure you have got a reserve available from there. The other big threat is that EPC requirement that's coming in from 2025 for new tenancy agreements, and going on to 2028 for existing ones, is with regards to the requirements of the EPC of the property from an E to a C. This could be very costly. If we go back to my previous point, have you got the time implication or energy EPC, to put in the time to get it up to standard? If you can't, is it the time to cut your losses and run and make that someone else's headache and move on to a property that doesn't need to have that? Because the non-compliance costs of that are going to massively increase, and you could be fined up to £30,000 if your property does not make the cut, so to speak. You can find out from the EPC register what is the EPC values of your property. Those underseas, yes, 2025 is a long way away. However, if you are under a C on the EPC then you need to start thinking about what you're going to do. Now, when you've done your EPC certificates, if it's been recently, it will tell you what you can do to get them up to standard. If you have not, pay some money and get an EPC certificate down, see where it is, and see what needs to be done. Okay, the things that will push it up a little bit are LED light bulbs and this, that, and the other palaver. The things which will probably have the biggest impacts are going to be cavity insulation, loft insulation, boilers, windows, those types of things. So you need to start thinking about those now. I was speaking to somebody on Friday and they were telling me that there's a big demand now from landlords moving back to new builds so they don't have to worry about this EPC thing going forward. But that's just something that I heard. Now, where are the opportunities going forward? And I believe there's going to be a lot of opportunities. There will be a lot of opportunities in the economic uncertainty that's going to happen, in my opinion, over the next 24 months. There are going to be properties that are coming onto the market. There are going to be an increased number of semi-commercial properties that are coming up to the market where you've got someone who's been trading their normal business downstairs and that's been working out over time and whatever. And through COVID, they got through with COVID support, but now they've made their money. They own the building, but they want to now retire. They've had enough. They want their money, put the property up. You could pick up a semi-commercial from there. If people are sick of dealing with tenants, and this is in the case of accidental landlords, i.e. who've got one or two properties, they could say, forget this, I've had enough of this, I want an easy life, let's get rid of the properties. And because you've got those first-time buyers there who aren't paying as much stamp duty, you could have more people who would be lapping them up for you. There might be other people who are re-weighting, re-leveraging their portfolio, increasing liquidity into the property market. And what has the property market been missing for the last few years? Liquidity. So hopefully, rather than it being a seller's market, we can turn the thing to put the ball back in your favor and put it back into a buyer's market. And as I always say, the profit in a property is made for the amount that you buy it. So I do think there's still a future for buy-to-let. I do think going forward, the mechanics are going to change. I do think it's going to become a lot harder. I do think deposits that you put into buy-to-lets or leave in your property are going to be greater, meaning potentially you might be not able to do as much as you need to do. But if you treat it like a business, have the best possible advisors and a good team around you, I think not only can you ride through this period that we're going through at the moment, but it could actually come out to be beneficial for you. So, ladies and gentlemen, that concludes my presentation for today. If you've got any questions or queries, then you can always email us through at the office, r3admin@r3mortgages.com. If it's a general inquiry, riz@r3mortgages.com for me.